Today, I'm talking to Duru Ahanotu, aka Dr. Duru, about valuing companies in digital media and advertising technology. Duru has a Stanford Ph.D. in engineering economic systems. He has decades of experience in digital media, working for companies like Microsoft and Yahoo. He is the sole proprietor of Ahan Analytics, a data analytics consultancy, and he is a prolific writer with commentary on analytics, financial markets, company earnings, inflation, and the economy. You can find him on YouTube as Dr. Duru Diagnosis Markets and at his drduru.com website. He is a prolific writer, lots of opinions about the ad-supported ecosystem. Duru, I am so looking forward to this conversation today.
And thank you, James, for inviting me, or should I say Dr. Deaker?
I don't usually play up my own PhD, but thank you, Duru. So you and I obviously have worked together many times, and actually we're at Stanford at the same time in the same department, which I wasn't going to mention. But let's get into digital media companies.
Yes.
You have a strong perspective on company valuation. When you are looking at companies in digital media or advertising technology, what are the first things that jump out at you?
So one of the first things, of course, are the standard analytics that people look at, which is revenue growth and earnings growth. And then I want to look at how do they define earnings? What are the key drivers of the components of the earnings? Are they leveraging old technology, old legacy products, or are they rolling out new products, new initiatives, keeping up with the latest changes and actually able to monetize on the latest technology? So those are the top things that I'll look at. Those are pretty standard, and people who do valuation of companies are pretty familiar with those techniques.
Okay, and so beyond that, let's talk about what's unique about digital media. Let's think about some of those unique risk factors then. When you think about risk factors for the digital media or advertising technology space, what are the top things that you think about?
So there's a few, of course. One is their pricing power, which is expressed in how much do they have to pay to get inventory. And the second one that we all know about is privacy, right? Data privacy, personal privacy laws are expanding and changing very quickly. And so you want to know whether the company you're looking at is keeping up with those changes and avoiding either legal liability or finding just unique ways of monetizing despite the changes in the privacy landscape. So those are the top ones. And then, of course, we have our standard ones, which is, well, what is the competitive landscape for the company? And as well as, what are the things that the competitor is doing, whether it's new technologies, new techniques. And then, of course, we have artificial intelligence to deal with and machine learning, right? Are they talking about algorithmic, new advances in algorithmic methods for monetizing ad inventory or stimulating demand for that inventory?
Got it. Let's stay on privacy for a second.
Sure.
And it's such a hot topic.
Yeah.
You clearly have the big companies, the Metas and the Googles, who are sort of in the eye of sort of the European regulators. But when you're thinking about the next level down below that, if you're talking about a global company, how prepared do you think that those sorts of companies are for the privacy challenges that they need to face?
I think a lot of them are thinking very carefully about how to be prepared, particularly in terms of getting a handle on first-party data, right? That doesn't require tracking people all over the internet with cookies. And clearly, I think in the future, that's going to be the key leverage that companies are going to have to use to be successful. And what you see now are companies, say, publishers who are trying to sell inventory, they are looking to then find out as much as they can about their users. So offering, incentives to sign up or subscribe to the service, starting off for free. But then if the ad dollars aren't coming in, of course, then they start to roll out the subscription fees. And that's also a migration we could talk about maybe later on in this discussion.
Actually, let's go there now, because I wanted to talk about one of the main sort of sources of value for so many digital companies is their relationship with the users. Obviously, sort of the holy grail is your user logged in? Do you have good information about them? Are they showing up every day? And so as you think about the continuum between sort of those companies that have the fully logged in users and presumably very good data about them, through to sites where it must be a more transactional sort of experience. I know some publishers use the phrase a tourist to describe sort of a user who just happens upon a news story on their site. And in those sorts of examples, an app or a publisher is going to get very little information. When you're looking at a company and you are trying to read their financials or do an outside-in assessment, what are the ways that you sort of would think about valuing how they work with their users and how valuable their user base is?
Well, before you even do that, you have to come to an appreciation for what is the product that they're selling, and how do users appreciate and use it. And I have to talk about Google when it comes to this, right? So Google is our big wild card because of the way that the search experience is constructed. And now with the way that generative AI is being embedded into search engines, well, we might as well talk about Bing as well. There is less, over time, there's been less and less incentive for users to click through to websites, right? And so when you're looking at the financials, I mean, revenue growth is, of course, the thing that will signal to you whether this company is being caught, in the undertow of the AI search experience. But you really have to understand what is the nature, what is the stickiness, as we say, of the product offering, the digital product offering that this company has. Because, like I said, over time, this AI search experience is going to reduce the incentive of users to click through to content, because of the way that so much of the questions that people answer are just being put right there in front of them, on the search engine result page, or the SERP.
So let's talk about, what it means to be a sticky user experience. Like we both have experience with email services we've had for 10 or 20 years.
Yes.
You and I happen to be in the same fantasy football league with Yahoo that was, I believe, set up maybe 15 years ago. And we would not move that league, even if there was a slightly better experience somewhere else. And so clearly it's possible to create very sticky experiences, partly because the switching costs are so high. But then you get other experiences where the pain can just be so great. And for me, something like Twitter, or now X, springs to mind, where you would think that was a built-in network effect, but the noise and the drama and everything got to the point where there was a viable switch in the form of threads, and now we see migration. As you are thinking about how sticky some of these experiences are, how do you think about that playing into the valuation of a company?
Yeah, so man, there's a lot packed in there. So let's talk about Yahoo first, because we both are very familiar with Yahoo. Yahoo is such a great example of the importance of stickiness, right? Yahoo has been around for a very long time. And over that time, as you know, there was a big expansive growth and then had to contract across some core properties, tried to expand beyond the core properties. There were these cycles, and then bam, contract back to the core properties. Those core properties have been around specifically because the Yahoo loyalists, Purple Forever, find those experiences sticky. And that has been an enduring value proposition for Yahoo. So that's one level of stickiness. Now, when we talk about social media, I think we're still in the early ages of understanding what is stickiness, because, we know about the migration from, let's say, Friendster to Facebook, and now we have the Twitter, and now we're going to go into open source like Mastodon or whatever. Every step along the way, it seemed like that new thing was the sticky application. And yet innovators have found new ways of creating social media. Now we have, and I think what's happening now with the experience with Twitter is people are finding out that, the network that I've developed on this particular platform is not as valuable as I thought it was. And you start to look at and we're talking about consumers, retail consumers, they start to look at who are the people whose opinions I really care about. If I can find them somewhere else, I'm good. Now, the value proposition is going to change a lot for news media organizations that have come to really rely on Twitter, right, to share their news stories. So that's going to be a different question. But I think what's clear is that the space in social media is still changing. I mean, TikTok changed the game, right, in terms of stickiness, the algorithm thing that just keeps you scrolling through. But I kid you not, I hope someone will look back on this video in 5 years and find out that, that whole scrolling thing got really old very quickly, and it'll be something else, some new thing. And what I hope, the new thing that's stickiness is trusted sources of information will become the new stickiness in the future. And, we'll see if that develops. So maybe you want to take this all the way back to valuation, right? Which is look at the advertiser base that Twitter, let's say, for instance, has, right? I think that the advertiser base is a good proxy for how sticky the product offering really is, because the advertisers are very keenly tuned in to the ROI that they're getting from the ad budgets that they spend on these platforms. And if you can get a read on, well, who are the advertisers on the platform? What is their distribution? So, is 20% of the advertisers producing 80% of the revenue, or vice versa, will give you a lot of insight into whether this company should be highly valued or not.
Duru, you're taking me in a direction that I hadn't thought we'd go today, but
Okay.
I really do want to go there. So, because
Okay.
you mentioned AI and you mentioned trusted news sources,
Mm-hmm.
and to some extent, they're almost, I won't say they're tangential to each other, but I don't necessarily hear them in the same. Right now, as you and I have this conversation in late 2023, every company, if you're a digital media company, has to have an AI strategy, right?
Yes.
The challenge is that it's becoming increasingly hard for consumers to be able to tell the difference as to what has been a genuine story written by a person and what's not. And this, actually, I don't usually like to reference recent news, but literally this week, Sports Illustrated got into trouble where many of the stories got written by AI, and a number of senior executives have lost their jobs. And so clearly, digital media companies are wrestling with some of these issues. As you are thinking about valuation from growth or not, I guess the simple question is AI overhyped in terms of its impact on valuation right now?
I mean, that Sports Illustrated story is a good one, where people kind of go too far and they're not thinking about, well, what is AI good at? Don't think of AI as a replacement for writers and editors and copy folks. Think of it as an assist. And what I always tell people is that generative AI, at least the way it is now, is just very good at giving you a structured view of content that you prepare for it. So I want a human to come up with the article idea. I want a human to write out the article and then feed it to AI to say, okay, give me your evaluation of this article based on these 10 criteria that I have for my audience. How well have I met that? But let the human be the idea generator, the creator, and the final editor, with just AI assisting at each of these steps.
So let me push you on that, Duru.
Oh yeah.
It's you and I as consumers want that experience.
Yeah.
If you think about how the market and other analysts are factoring in AI or not, do you think we're seeing companies being punished if they don't have an AI strategy? And the flip side, do you think that they're getting overinflated valuations if they are touting their AI at the moment?
Yes. So so much packed in there. So what I'm seeing is there's this hype cycle, right? I think Gartner has that whole hype cycle where, yes, companies got huge valuation bumps in the early part if they just mentioned AI. But then over time, what happens is the analysts say, well, you mentioned 3 quarters ago that you had all these great ideas. Now, where's the product?
Yeah.
Now, if the company is prepared with the product, then they can still tell a good story. The analysts will continue to give them a premium valuation. But at some point, and I think we're either at that point now or we'll be there next year, they're going to want to see, well, what are the financial impacts of this product? What's the adoption rate? What is the, basically where are you on this adoption curve for that product? And if companies don't have that, then yes, it's going to completely fall apart in terms of their valuation, and people will see right through that. We've seen these hype cycles in technology before, right? So we know how the game is going to play out in terms of the hype curve. So yeah, I appreciate the pushback on that, but I think the real stuff will filter out. It just takes time because everyone's just really excited about the potential, and they should be, right?
Staying on sort of valuation and how we think about companies, when lots of people look at financials, they look at the top line. Some look at EBITDA. I would argue that most don't go deep enough into things like stock-based compensation. And there are certainly examples right now in our industry where if you factor in the stock-based compensation, it can take a company that would otherwise look like it's very profitable, and actually, when you dig in, it's unprofitable. I know previously some notable investors have said that stock-based compensation should just be treated like an ordinary cost, because it is, but for some reason we treat it in a different category. How do you think about it?
So, this dates back to the dot-com bubble days, right? This was a huge hot button issue. And sure enough, those companies that were dedicating a lot of their free cash flow to stock-based compensation did not do well. So I think for an analyst, it's to your advantage to look at those kinds of things, like stock-based compensation, because they will tend to reduce. I shouldn't be absolute about it. They'll tend to reduce free cash flow and the cash that's available to invest back into the business. So yeah, I would highly encourage folks to look at that line, even as the company will report the adjusted numbers, right? To take out the things that make the financials not look as good. And again, this is another one of these things where over time, excessive stock-based compensation will erode the company's true financial strength and valuation. It's all a matter of whether the analyst is prepared to look ahead now or wait until the story falls apart towards the end.
Okay. What is something that you believe when you're looking at valuations that is different than other mainstream commentators or analysts?
So, I'm going to say something that's going to make fundamental analysts just cry or just get itchy, which is I will take into account technical factors. And the way I justify this is, would you invest in a company whose profit, whose earnings per share, let's just say, is in an uptrend or in a downtrend? I think you would say, I want to invest in a company whose earnings, revenues, so forth, are in an uptrend. So then why would you invest in a company whose stock price is in a downtrend? Wouldn't you prefer to get a company that's in an uptrend? So the technicals are all about just assessing, well, what is the health of the stock price action? And so you take your fundamental analysis and marry with the technical, and hopefully the two are a consistent story. Now, where you can have opportunity is when the, let's just say the stock price is not reflecting what you think are the fundamentals, but you still have to be patient, because it doesn't matter how strong your fundamental analysis is. If the market disagrees with you for 2 years, you can go broke. So that's the unusual part that I bring to the table when I look at these things, is I actually care about the technical health of the stock. And I'm not talking about day trading and looking hour by hour. I'm talking about the intermediate and the longer term stock price trend. Then the other thing is the economic environment. Now, I know there's some fundamental investors who love to ignore macroeconomics. But when it comes to our industry, the digital media industry, we know that they are very sensitive to economic cycles, because in recessions, people tend to contract their spending, and then advertisers will also contract their spending because they can't get the ROI anymore. So the macroeconomic factors on the fundamental side, the technicals of stock price action on the other side, is what I would bring to a fundamental analysis. I think is a little different than what most people do.
So I intended to wrap up, but I do these so I can learn. And as you know, I'm more dubious about technical investing than others. And I have also read enough, a little bit, to be dangerous, and have found the shapes of some of the curves confusing, and the names that get attached to.
Oh, yeah.
So we're not going to get into all of that. But I will ask them, when you have conviction that a stock is a good stock,
yeah,
but the technical analysis is trending in the wrong direction, what would be the kind of thing that would make you say, okay, now is the time to jump in? Because there's all
yeah.
these concerns that people are saying you can't time the market or you need extra information. What are the kinds of things that you would look for that would say, I've been waiting for this stock, that I have belief that it's going to grow, and now something technically has changed, without getting too in the weeds?
Yeah. No, I'm not going to get in the weeds, because I am definitely one who uses very simplified technicals. I don't throw in all of these cloud formations and waves and all that kind of stuff that's out there. I keep it so simple. And what I would say is that people do get hung up with the timing aspect, but a good technical analysis is not about timing. It's about managing risk. So when you're bringing in, so you have this company you just love, all the fundamentals are lined up, but the price is trending down, and you don't understand, and you think the market is wrong, which is also very dangerous in of itself, to tell the stock market that it's wrong. But let's just say that your analysis tells you the market has this story wrong and it's in a downtrend. Simple answer: wait until that downtrend ends. How do you know the downtrend ends? Because you create a moving average. The 50-day moving average is good for intermediate term, and wait until the stock goes above that 50-day moving average as your starting point to buy. And particularly when you're in a bear market or economic conditions are bad, you're going to save yourself some money and some pain by just using that simple approach. Now, on the more risky side, when we're having a market collapse, there are ways of measuring what we call oversold conditions, where you're de-risked just because so much selling has already happened that you feel pretty good about buying there. But to keep it simple, buy when a stock's downtrend has finally apparently come to an end. But again, no guarantees in anything.
Brilliant. Thank you. Duru, thank you for taking the time. If people want to read more insightful analysis from you, what's the best place to find you within either video or written format?
Yes. So my main site is drduru.com, but I will send people to one of two places. So if you like the technical story, if you like different stock narratives, go directly to drduru.com/122, all letters, no spaces, no numbers. And then if you love the fundamental analysis, I have all sorts of quirky ways of looking at companies at seekingalpha.com. And you can find me by just typing in Ahan Analytics, which is the name of the data analytics consultancy that I run.
Excellent. Thank you, Duru. I really appreciate the time. This has been a really fun conversation. So
yeah,
catch you later. Thank you so much.
Talking to you.
Bye.
Bye-bye.